This is my annual report project for ACC 202 Managerial Accounting. I chose to evaluate the company Intuit Inc. Their industry classification is application software, and the business sector they operate in is technology. Intuit has a company background as a major accounting and tax software developer and provider. Globally, they have approximately 100 million customers. Their primary products and services include the software applications QuickBooks, TurboTax, Credit Karma, and MailChimp. Intuit's corporate headquarters address is at 2700 Coast Avenue in Mountain View, California, zip code 94043. Intuit's website address is simply www.intuit.com. A list of countries in which the company operates includes the United States, Canada, Ireland, the United Kingdom, Israel, India, and Sydney. Revenues for the 2024 fiscal year were totaled at $16.285 billion. $16,285 million. The chairman for Intuit's board of directors is Suzanne N. Johnson, and their chief executive officer is Sasan K. Godarzi. The stock exchange they operate on is NASDAQ, and their ticker symbol is INTU. The closing price of the stock for the 21st of April 2025 was $568.84. In the past 52 weeks, the lowest value of the stock was $532.65, and the highest was $714.78. The letter to the stockholders was written by Intuit's CEO. It opened by discussing AI and the significant impact it is having thus far on the technology sector, and particularly the company. Sasan points to statistics indicating revenue growth and further development of Intuit from accounting company to tech giant, making sure to highlight that Intuit is in a position of strength. It is evident from the letter that he is trying his best to stir up confidence in shareholders regarding Intuit's future and goals. Intuit's management oversees preparing and ensuring the integrity of the company's financial statements. Intuit maintains a system of internal controls, which are important because they ensure that the data shown in the financial statements will be honest and accurate, that the company is abiding with the law, and with the goal of preventing fraud. Intuit does have an audit committee, the purpose of its existence being like that of the external auditor. Additionally, having an internal auditing committee helps to further regulate the information on the financial statements. The name of the independent auditor is Ernst & Young, LLP. The auditor states that their responsibility is to express an opinion on the company's financial statements based on the independent audits. According to the independent auditor's letter, audits include performing procedures to assess the risks of material misstatement of the financial statements, whether due to error or fraud, and performing procedures that respond to those risks. The opinion of the auditor was that Intuit's financial statements portrayed a faithful representation of their financial position between the years of 2024 and 2023, and that Intuit abided by GAAP principles as respect to their operations and cash flow recognition for the 3 years ending 2024. Intuit's assets for 2024 were $32,132 million. Its liabilities were $13,696 million, and its equity was $18,436 million. Intuit's assets for 2023 were $27,780 million. Its liabilities were $10,511 million, and its equity was $27,780 million. From this, it is apparent that the company's assets went up, as you can see, and the equity decreased. There. The current ratio is a way to measure the company's ability to meet short-term liabilities with the current assets it has available. The greater the ratio, the easier it is for the company to pay off that debt. Intuit's current ratio for 2024 was 1.29, and for 2023 it was 1.47. Intuit's ratio has maintained a rate of above 1.0, which indicates that it has sufficient current assets to pay its current liabilities. However, the ratio did take a dip by 0.18 points between 2023 and 2024, which indicates that the ratio has worsened slightly. Here, we're given a glimpse into Intuit's balance sheet for 2024 and 2023. All numbers in the first two columns are in millions. The third and fourth respective columns in the sheet represent the percentage of total assets that rows item represents. From greatest to smallest, Intuit has its most significant asset investment in goodwill at 43.08%, acquired intangible assets at 18.11%, and funds receivable and amounts held for customers at 12.2%. It appears that Intuit is financed primarily with equity instead of debt. This can be seen when analyzing the values in the past two slides, as equity makes up the greater percentage for the right side of the accounting equation. The greater portion of Intuit's debt is long-term. Assets overall increased from 2023 to 2024, jumping from $27,780,000,000 to $32,132,000,000. Liabilities also increased between those 2 years, from $11,051,000,000 to $13,696,000,000. The composition of current assets increased from $5,557,000,000 to $9,678,000,000, and of current liabilities from $3,790,000,000 to $7,491,000,000. Intuit's debt-asset ratio remains high, and it possesses enough resources to pay off debts it has incurred. Intuit's gross profit ratio was 78.72% for 2024. 78.13% for 2023, and 81.09% for 2022. The ratio of operating expenses to operating revenue was 55.06% for 2024, 56.26% for 2023, and 60.895% for 2022. Their profit margin was 18.19% for 2024, 16.59% for 2023, and 16.23% for 2022. Their return on assets was 9.89% for 2024, 8.58% for 2023, and 9.55% for 2022. Displayed is a spreadsheet of Intuit's income statements for 2022, 23, and 24, respectively. The three final columns are percentages calculated as the row item divided by the total net revenue per year. There has been a solid trend of growth between the 3 years, with total revenue climbing from $12,726,000,000 in 2022 to $16,285,000,000 in 2024. The gross profit percentage dropped from 81.09% in 2022 to 78.13% in 2023, but then raised again slightly to 78.72% in 2024. The ratio of operating expenses has been gradually decreasing over the 3-year period, 60.89% to 56.26% to 55.06%, which could indicate that Intuit is becoming more efficient at managing its expenses in relation to its revenue. This is an excellent development. Neither of the revenue items on the income statement had extreme percentage value changes. It was quite a similar case with the expense items, excepting that cost of service revenue raised from 17% in 2022 to 20% in 2023. Operating income increased from 20% in 2022 to 22% in 2023, and it remained constant through 2024. Net income raised by 1% each year, climbing from 16% to 18% by the end of 2024. The changes indicate, if anything, a positive turn for the company. Though the increases in revenue and income are slight, that's still a great trend because it shows that Intuit is becoming better able to manage its expenses and increase what is being brought in. As a note, quite possibly, the reason for the gross profit percentage dropping in the 2023 to 24 fiscal year was that COVID was beginning to wane. Lives were returning to normal. A great deal of focus was placed on trying to handle things online during the pandemic, so it's likely that a number of new customers were testing the waters during that time. And when the time came for them to renew their subscriptions, they simply dropped them. Intuit's total accounts receivable was $462 million for 2024 and $412 million for 2023, and their net accounts receivable were $457 million for 2024 and $405 million for 2023. The company had an allowance for doubtful accounts of $5 million in 2024 and $7 million in 2023. Its gross accounts receivable were $452 million in 2024 and $398 million in 2023. Cost of goods sold was $3.465 billion for 2024, $3.143 billion for 2023, and $2.406 billion for 2022. Intuit is a digital tech software company, thus they don't really have any inventory to sell per se, I couldn't find anything on the balance sheet that specifically constituted inventory. Intuit Inc.'s receivables turnover ratio was 37.78% for the fiscal year of 2023 to 2024, which was a 4% increase over the 33.78% ratio for 2022 to 2023. The average collection period ratio also dropped from 11 days in 2023 to 10 in 2024. Positive developments because they signify that Intuit is becoming more efficient at turning its receivables into cash. Intuit is a digital technology company, and since they don't manufacture or sell hardware, they don't have what would usually constitute as inventory. Instead, their products are almost entirely digital software subscriptions and downloads which are delivered electronically rather than physically stored or shipped. Intuit Inc. uses the straight-line depreciation method for a consistent and accurate estimate of asset aging. Intuit's depreciation expense was $159 million for 2024 and $160 million for 2023. The company's 2024 intangible assets are totaled at $5,820 million. Intuit also reported goodwill of $13,844 million for 2024. Intuit's average useful life of plant assets for 2024 was 6.22 years, and its average age of plant assets was 8.57 years. The company's asset turnover ratio was 0.93 for 2024, 0.52 for 2023, and 0.59 for 2022. Its return on assets was 16.98% for 2024, 8.59% for 2023, and 9.55% for 2022. Depreciation expense can reduce the profits that a company reports, which in turn lowers the amount of income tax that the company pays. Less income tax expenses can translate to greater cash flow. The average useful life of Intuit's plant assets was less than the average age of its plant assets. This could indicate a need to replace some of those assets, but it also suggests that the company is doing a good job of maintaining them. Intuit's capital expenditures were $191 million for 2024 and $210 million for 2023. The company's capital expenditure ratio was 25.57 for 2024 and 24.03 for 2023. Intuit's capital expenditure ratio for 2024 is high, indicating that it is currently stable enough to finance its own capital spending via operations income. Intuit's current liabilities were $7,491 million for 2024 and $3,790 million for 2023. Long-term liabilities came in at $6,205 million for 2024 and $6,721 million for 2023. According to the financial statement notes on page 87, Intuit has additional operating leases that have not yet commenced but are estimated at $124 million. Intuit's current ratio was 1.29 for 2024 and 1.47 for 2023. The current ratio represents Intuit's ability to pay off current liabilities with current assets. It dropped slightly between 2023 and 2024, and it remains above 1, which is suitable, but it could indicate that more focus needs to be placed on the company's financial health. Intuit's acid test ratio was 0.54 for 2024 and 0.86 for 2023. The acid test ratio gives an idea of Intuit's ability to extinguish current liabilities immediately. Similarly to the current ratio, it dropped between 2023 and 2024, except in this case it's a bit more concerning as the latest AT ratio is only 0.54. This means that Intuit needs to give its quick assets more attention. Intuit's debt to total assets ratio was 0.43 for 2024 and 0.38 for 2023. The debt to total assets ratio is meant to show the percentage of assets financed by debt. Generally, the lower the ratio, the better. The change in the ratio between 2023 and 2024 was minuscule and might not require immediate attention. Intuit's debt-paying ability appears that it could use some attention based off the values of the calculated ratios. All of them are just outside of the range of a healthy company. The current ratio was 1.29 for 2024, and this is a bit concerning because the best range for this ratio was above 1.5. The acid test ratio also dropped 0.32 points and was at 0.54 for 2024, which is something to think about because the best range for the AT ratio is above 1. With the debt to total asset ratio, that's a bit different from the others because a value lower than 1 is generally safer. Intuit's DTTA ratio was 0.43 from 2024. It appears that Intuit needs to put some emphasis on reining their asset-based financing back in. Though the numbers aren't bad, they seem to be trending in a negative direction and could use attention for sure. Intuit has 469,732 shares of common stock issued and 280,292 shares of common stock outstanding. The company was not found to have any shares of preferred stock outstanding. Intuit reported $18,750,000,000 in treasury stock and $54 million in accumulated other comprehensive income. See page 61. Intuit's dividend payout ratio was 33.75% for 2024 and 37.67% for 2023. The dividend payout ratio tells the percentage of Intuit's net income that was distributed as stock dividends. Intuit's dropped slightly between 2023 and 2024, and it remains suitable. Intuit's dividend yield was 0.58% for 2024 and 0.17% for 2023. The dividend yield shows the annual payments that Intuit makes in dividends compared to the stock price. The yield for the company grew nicely over the past fiscal year, which would most likely be considered attractive to investors. Intuit's earnings per share was $10.58 for 2024, $10.58 for 2024, and $8.49 for 2023. Earnings per share is meant to help understand how much Intuit is making off each share of common stock. Intuit's EPS remains positive, though it dropped over the past fiscal year. The company's price-earnings ratio was 59.3 for 2024 and 72.93 for 59.2. The PE ratio is supposed to show how the price of Intuit's stock compares to its value in terms of what will be earned by the investor. Currently, it remains high, perhaps signaling overvaluing. The return on common stockholders' equity was 16.6% for 2024 and 14.14% for 2023. ROC is used to show the efficiency of Intuit in using the investment of stockholders to generate profits. From the numbers, it seems like the company could be doing a more efficient job. Intuit received $282 million from the issuance of common stock during 2024 and $228 million during 2023. The company paid $18.75 million to purchase treasury stock in 2024 and $16.77 million during 2023. It also paid $1 billion in dividends for 2024 and $898 million for 2023. Based on the standards above, a net decrease of $699 million in 2024 and $653 million in 2023 was taken. It appears that Intuit's common stock is overvalued right now, as the ratio for 2024 of 5.59.2 is high. This is likely due to their recent plans of growth and excitement surrounding that news. The dividend yield is decently attractive, however, which would be something for investors to consider. It seems like Intuit puts a lot of focus on dividend payouts, which is probably a reason their stocks are valued so high as well. As an investment, the benefits of the company's stock are surely enough to draw attention. The period covered by Intuit's statement of cash flows is grouped into three columns: 2022, 2023, and 2024. Each of the periods has an ending date of July 31st. The ending balance of cash and cash equivalents for 2024 was $3,609 million. This is equal to the value reported on the balance sheet. Net income for 2024 was $2,963 million. For 2023, it was $2,384 million, and in 2022, it was $2,066 million. The net cash outflow from investing activities was $227 million. Originations and purchases of loans held for investment was the greatest cash flow for investing, and it was an outflow of $2,538 million. The net cash outflow from financing activities was $397 million. Repayments of debt was the greatest cash flow for financing, and it was an outflow of $4,002 million. The net cash inflow from operating activities was $4,884 million. Intuit used the direct method for reporting cash flows, and you can tell this because the sources of income for operating activities were all specified at the beginning of the statement of cash flows. Free cash flow was $3,693 million for 2024 and $3,938 million for 2023. FCF represents what cash a company has after calculating operational and capital costs. In essence, it's money left over after basic needs have been met. The current cash debt coverage ratio for 2024 was 86.59%. The current debt coverage ratio shows the ability a company has to pay off current liabilities using cash generated from operating activities. In this case, it appears that Intuit's is decently strong. The cash debt coverage ratio was 40.35% for 2024. It holds the same idea as the last calculated ratio, except that it covers all liabilities and not just current ones. It makes sense why the percentage for this calculation would be roughly half of the current coverage ratio, since total liabilities are almost double. The cash return on sales ratio was 29.99% for 2024 and 35.12% for 2023. ROF represents the profit that is generated by a company for every dollar of sales, or in Intuit's case, operating revenue. It seems to be that Intuit's ROS dropped about 5% over the past year, but the value remains over 20%, so it's still suitable. Based on the ratios calculated, Intuit's current liquidity is in a decent place. One moment, apologies. With a cash debt coverage ratio of 86.59% for 2024. This is an excellent value. Intuit has the resources to pay off most of its current liabilities. Intuit's solvency could be better. Last year ended with it at 40.35%, and such a value warrants some attention. Intuit may not be able to pay off all its liabilities quickly if such an instance came up. Intuit's profitability dropped over the last fiscal year, ending at 29.99%. If such a trend continues, it could be concerning, but the percentage is still decent for ROS. Intuit has fine probability as of 2024. So after giving some consideration to the idea of investing in Intuit, here's my 2 cents. Intuit's revenue and expenses have both grown at a similar rate over the past 3 years, and so has its net income. This is a positive trend for sure. The company has an asset base built up mostly of goodwill and intangibles, and its assets have increased by roughly 14% over the past fiscal year. Based on the cash debt coverage ratio, Intuit has decent capability to pay off what debts it has with cash assets. Its liquidity is strong, and though solvency is less so, it remains strong. The company does an excellent job of caring for its plant assets, with the average age of most surpassing their expected lifespan. The company's profitability did drop slightly during the past year, but not enough to be concerning. With the amount of growth that Intuit has been experiencing, plus what they're expected to see in the future, and the focus that they put on their stockholders, I think it is certainly safe to say that Intuit would be an excellent investment.